Let's bring in Ted Oakley. He is Oxbow Advisory Managing Partner there. And Ted, it's interesting we're talking about this because you say that you're actually starting to have a more positive outlook on energy for a number of reasons. Yes, we've seen some economies started to open up. We've seen some of the demand pick up. And yet I have to wonder where the positivity or the outlook is coming from.
Well, Akiko, you have to look at supply demand and what's happened here. You look at, for example, just start on the base case of drilling. The rig count's down to about 181, down from 900. Means they're not doing very much. And so that's going to change the supply demand picture out over the course of the next year or two. And what the other thing we're seeing is we're starting to see commodity prices rise, not just oil but metals, agricultural products, that sort of thing. But one of the big overriding things for us is we think the dollar will fall and it's becoming weaker. And that being the case, that's going to price out in oil as well. So we think it's ahead. We think that's something that's probably not in the marketplace right now.
Ted, how are you positioning yourself in this space right now? Yes, it sounds like you're saying we're sort of starting to see some of the balance return to the market, and yet the long-term trajectory still doesn't necessarily look good.
That's true. For right now, we're doing things that we know can create cash flow now. For example, we own the pipelines. We own Enterprise, Kinder Morgan, and Magellan. And on the other hand, we own the royalty companies, which in this case happens to be Brigham Minerals. That's an early on because when you get those movements to the pipelines will go on no matter what. And from a royalty standpoint, they're the first people to benefit when the price of oil goes up. On the producing side, you ease into that a little bit slower, but if I were looking at that area, it would be Chevron and probably EOG.
Let's talk about earnings. When you look at some of the initial reports that came out last week with the banks, you could argue that things were a little more positive than expected, although the expectation was so low going into this quarter. It's not necessarily hard to beat that. What's on your radar as we go into the thick of things this week?
Well, we don't own any banks because we felt like the numbers they came out with were a complete fake out, Akiko, because they were primarily from trading, which does you no good on the bank side. And having owned part of a bank myself, I know what the trouble they're going through right now. But on the other side, I guess we're looking for a big down in the overall earnings for the second quarter, probably 40-45% if you look at the total. And I suppose the third quarter is going to be down year on year. I can't see this year not being down all the way through the end of the fourth quarter, year on year. And so from our standpoint, we're having to choose companies we feel like can hold their earnings fairly stable. At the same time, they don't have a lot of debt. And that's where we're looking right now.
What specific companies or what particular sectors are you talking about?
Well, if you look at the companies that we like, that we would add to, or we've been adding to probably, in some sectors, for example, with a dividend, we would look at Unilever or maybe Pfizer. If you look at the growth side, Alibaba is a stock we like in terms of what it does. It basically is the Amazon of China, that type of company. United Health, we feel like the demographics are good for those companies. So all of that combined, we feel like will do well over the next 12 months.
What about some of the tech names? We had a guest on earlier who said, especially with these stay-at-home trades, he thinks the expectation has gone way out ahead of where the company should actually be. And so he thinks that this is kind of time to pull back from them. How do you see that growth trajectory? Because at the end of the day, it seems like that's sort of the fallback trade, or has been for the last several months.
You're right, Akiko. That's been the fallback trade. And what happens is they usually run past where they should be. And when they do, and you get a bout of profit taking, and you saw that a little bit last week. I don't know if you remember that day when the NASDAQ was up 2% and closed down 2%. Those are not good signs. This typically gives you a little bit of chink in the armor in those stocks. I would estimate that you'll have a period in here somewhere where profit taking will set in. Doesn't mean they don't come back one more time or one or two more times, but you always have to be a little careful of leaders because they look invincible until they're not.
Some good words of caution there. Ted Oakley, always good to get your insight. Appreciate your time today.
Thanks, Akiko.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.